Today, I want to talk about conventional loans. And I know what you may be thinking, Lisa, that sounds very official and very boring. But hang with me, because conventional loans are one of the most common mortgage options that's out there. And for the right buyer, they can be a really strong fit. A conventional loan is a mortgage that is not backed by the government. So it's different than FHA, VA, and USDA loans. FHA loans are backed by the Federal Housing Administration. VA loans are backed by the Department of Veterans Affairs. And USDA loans are backed by the U.S. Department of Agriculture. So conventional loans are not backed by one of the government agencies, but they do still follow specific guidelines, usually connected to Fannie Mae or Freddie Mac. Now, let's talk about why buyers like conventional loans. One of the biggest reasons is flexibility. Conventional loans can work for primary homes, second homes, and investment properties. Depending on the full scenario, they can also offer competitive interest rates, different mortgage insurance options, and more flexibility when it comes to removing the mortgage insurance later. And this is where I want to bust a big myth. A lot of people hear conventional loan and immediately think, oh, that means I need 20% down. Nope, not necessarily. 20% down can be great if you have it because it may help you avoid the monthly insurance requirement, but it is not always required. There are conventional loan options that may allow qualified buyers to put down much less than 20%. Some programs may even allow as little as 3% down for eligible buyers, and that's less than FHA. So please, do not count yourself out just because you do not have this giant pile of money sitting around labeled Future House Fund. Although, if you do have one of those, I fully support it. Go you. Now, let's talk about mortgage insurance. With a conventional loan, if you put less than 20% down, you will typically have private mortgage insurance, also called PMI. But one of the advantages of conventional financing is that PMI may be removable later when you have enough equity in the home and meet the requirements. That can be a big difference compared to some other loan programs where mortgage insurance may stay for the life of the loan unless you refinance. And that matters because we are not just looking at, can you buy the house? We are also looking at, does the loan structure make sense for you long term? What does the monthly payment look like? What are the upfront costs? What happens in a few years? And does this fit your actual life and not just a perfect spreadsheet? Because listen, spreadsheets are awesome and I am a big fan, but they don't know that your kids need braces, your car is making that weird noise, or that at some point in the next 5 years, you might like to take a vacation. So when does a conventional loan usually make sense? It can be a great option for buyers who have stronger credit, steady income, manageable debt, and enough savings to make the overall numbers work. It may also be a good fit for buyers who want to minimize long-term mortgage insurance costs, buy a second home, purchase an investment property, or have more flexibility in certain areas of the loan structure. But, and this is important, conventional is not automatically better. This is where buyers can get tripped up because sometimes people think conventional is the grown-up loan and FHA is the starter loan, and that is not really fair or accurate. The best loan is not the one with the fanciest name. The best loan is the one that fits your credit, your income, your savings, your goals, your property, and your long-term plan. For one buyer, FHA might be the best path because it gives them more flexibility with credit or debt to income. For another buyer, conventional might save money over time and create a stronger long-term structure. For a veteran, VA may be the clear winner. And for someone buying in an eligible rural area like ours, USDA might be a fantastic option if they meet the income and property requirements. This is why I do not believe in just guessing. I believe in comparing. When I work with the buyer, I do not want to just say, here's a loan, good luck, may the mortgage odds be ever in your favor. No. I want to look at the options side by side. What is the payment? What is the cash to close? What is the mortgage insurance? What are the long-term costs? What makes the most sense for your situation and your goals? Because the right loan program can make a big difference. So here's the takeaway. A conventional loan can be a great option for many buyers, especially those with strong credit and a solid financial profile. But it is not one size fits all. Because what loan is? You do not always need 20% down. You may have options with a lower down payment. PMI may be removable later, and conventional loans can offer a lot of flexibility. But the only way to know if it's right is to compare it to the other options available to you. So, if you're thinking about buying a home and wondering whether conventional, FHA, VA, USDA, 184, or another program makes the most sense, let's look at the numbers together. My job is to help you understand your options, make a smarter plan, and choose the mortgage that fits you best. Call or text me and let's find the right path home. There's my number.